Welcome back to FiNews, your trusted source for financial insights. In today's video, we'll be discussing a topic that has been making headlines recently: the potential impact of a US debt default on the stock market. The US government is currently facing a critical deadline to raise its debt ceiling, and if Congress fails to reach an agreement, it could result in a default for the first time in history. So, let's dive into what a US debt default could mean for the stock market. Our first scenario involves a short-term default with a quick resolution. This situation could be similar to what happened back in 1979, when the US government accidentally defaulted on a small amount of its debt due to a technical glitch. The default only lasted a few days and was quickly resolved. In this case, the stock market may experience a temporary drop as investors react to the uncertainty. However, as confidence in the US government's ability to pay its debts is restored, we could expect a swift recovery. Historical data suggests that the 1979 default had minimal impact on the stock market, which continued to rise in the following months. Now, let's move on to a more concerning scenario: a prolonged default with a delayed resolution. This situation could be similar to the debt ceiling standoff that occurred in 2011, which resulted in Standard & Poor's downgrading the US credit rating. In such a scenario, the stock market could experience a severe decline. Investors may lose faith in the US government's creditworthiness and stability, leading to a significant drop in stock prices. According to a report by JP Chase, a default of this nature could potentially cause a 35% decline in the S&P 500 index, which would wipe out trillions of dollars of wealth from US households and businesses. Furthermore, the report warned of a possible global financial crisis, as US Treasuries serve as a benchmark for interest rates and a safe haven asset for many countries and institutions. Now, let's consider a worst-case scenario: a catastrophic default with no resolution in sight. This situation could be compared to Argentina's default in 2001, which led to an economic collapse and years of turmoil. If the US government were to remain in default indefinitely, the stock market could experience a complete meltdown. Investors would likely flee from US assets, seeking refuge in other currencies and commodities. A report by Moody's Analytics warned that such a default could potentially result in a 45% drop in the Dow Jones Industrial Average, wiping out trillions of dollars in wealth. The repercussions would extend beyond the US, as trade and investment flows would be disrupted, and confidence in the US dollar would be shattered, possibly leading to a global depression. To gain further insights, let's look at historical examples and expert opinions. While each default scenario may have unique factors, there are valuable lessons we can draw upon. In the short-term default scenario of 1979, the stock market experienced a temporary drop, but quickly recovered as investors regained confidence in the US government's ability to meet its obligations. This indicates that the stock market can be resilient in the face of a short-lived default. However, in the prolonged default scenario of 2011, we witnessed a more significant impact. The uncertainty and brinkmanship surrounding the debt ceiling led to a downgrade in US credit rating and a considerable decline in the stock market. This highlights the importance of resolving the debt ceiling issue promptly to mitigate negative consequences. As we wrap up, it's important to note that a US debt default is unlikely but not impossible. Investors should remain aware of the potential risks and be prepared accordingly. To hedge against a possible default, diversifying your portfolio across different asset classes and regions is a prudent strategy. This approach can help mitigate the impact of a default on your overall investment holdings. Additionally, staying informed and monitoring developments closely will help you adjust your investment strategy as needed. Pay attention to news and updates regarding the debt ceiling negotiations to make informed decisions. In conclusion, a US debt default would have significant implications for the stock market, ranging from temporary drops to severe declines and even the potential for a global financial crisis. While the likelihood of a default remains uncertain, it's crucial to understand the potential risks and take appropriate measures to protect your investments. That's all for today's video on the potential impact of a US debt default on the stock market. If you found this information helpful, don't forget to like and subscribe to FiNews for more financial insights. As always, thank you for watching, and we'll see you in the next video.